today's lesson, we are going to be looking at one very important topic that as a student preparing for WAEC, JAM, or any external exam, you can't go in and come out without maybe one or two questions from the topic. Very important in accounting. It is bank reconciliation statements. Bank reconciliation statements. You know, as the name implies, bank reconciliation statement is a statement that is prepared to reconcile differences between the cash book and the bank statement. But before then, let me quickly spell out what we are looking at as objectives. At the end of this lesson, we should be able to define what bank reconciliation statement is. We should be able to explain the differences, the reasons for the differences between the cash book and the bank statement. And then we should be able to solve or answer related questions. And then what we serve as a success criteria, number one, how our ability to be able to define bank reconciliation statement, our ability to explain reasons for the differences between the cash book and the bank statement, and our ability to solve or answer related questions or problems. Now let's look at an introduction. There is no business that will spend money without making preparations on how to record the money that is being spent. So every business will spend money and then make a preparation on how to record the money that is being spent. Now, when this money is spent, if it's spent in the form of cash or check, they are recorded in the cash book. And if it is check, you have to take the check to the bank, because the bank is the only institution that is licensed to receive or to issue check. So when the money is spent, if it is cash or it is check, it has to be taken to the bank. Then the business will also look for a way to record the money that they have taken to the bank, while the bank will look for a way to record the money they are receiving from their customers. So the cash book is there to record transactions that is centered on cash and check, receipt and payment, while the bank is there to record transactions between the bank and the customer. So as you can see, I said a business enterprise will record money paid into the bank, and the sum drawn from the bank will check into the cash book, while the bank will record all the transactions in its own book. Now, the book which the bank prepares showing the transactions between it and the customer is known as bank statement. Please, let's not forget this. I want to emphasize on cash book and bank statement, because the topic is like a mediator between the cash book and the bank statement. So if you don't have a good knowledge of the cash book and the bank statement, you may not understand or appreciate the topic. Now, let's quickly look at the definition again. We said that it is a statement that is prepared to reconcile the disagreement of the cash book and that of the bank statement. The reconciliation is necessary in order to test the accuracy of the posting in the cash book by reconciling the balance of the cash book with that of the bank statement. What do I mean by reconciliation? Another word for reconciliation is to establish an agreement. There is a discrepancy. There is a disagreement. There's a loggerhead between the cash book and the bank statement. So the book or the statement that is prepared to bring these two disagreed accounts together is what we call the bank reconciliation statement. Now ask me, what could be responsible, or what will make the bank statement not to agree with the cash book? That will be the next thing to look at now. That will take us to what we call reasons for the disagreement. There are transactions that may affect the balance of the cash book and the balance of the bank statement. Some transactions, when these transactions are carried out, it will cause the cash book not to balance with the bank statement. The first one is what we call unpresented check. Unpresented check. Now, as a businessman, there are times when you can issue a check in favor of a customer, but you may not tell the customer when the customer is expected to take the check to the bank. So when you issue this check out to the customer, you have already credited your cash book that you have given out check in favor of somebody, but probably the person has not taken that check to the bank for payment. And if it happens that the bank send you your bank statement before they receive the check, you will see that the balance of the bank will be higher than that of the balance of the cash book. Assuming you were having 10,000 in your bank account, and then you have 10,000 in your cash book, and then you now issued out 5,000 from your cash. Now that check has reduced your cash to 5,000 while the bank is still 10,000. So if the customer has not taken that check to the bank for payment, your bank will still be reading 10,000 while your cash book will still be reading, will now be reduced to 5,000. So unpresented check will cause the bank statement to be higher or greater than the cash book. The next one is what we call uncredited check. Uncredited check is not a direct opposite of unpresented check, but it is called uncredited. It has a very slight difference. The difference is that in the first instance, we issued out the check to the customer, but in this second instance, we are the one receiving the check from our customers, or from our customers. Now, somebody, assuming the business, you sold out something on credit to a customer, and the customer decide to pay us with check. If we receive a check of 20,000 and then taking the check to the bank, sometimes the work of the cashier will be so bulky that the cashier will not have the time to effect the check on the account, the bank account. So what will happen is that when this check gets to the bank, it's either the cashier has not credited this check in our account, or we have not taken the check to the bank. In the first instance, it was our customer that has not taken the check. But in the second instance, we are the one that have not taken the check to the bank. So because we have received the check will increase our cash. If we are having 10,000 before and we receive a check of 5,000, that will make it 15,000. So until this check is taken to the bank, for it to be added to the bank balance, the cash book will be greater than the bank statement. Please, let's not forget, in the first instance, the bank was higher than the cash. In the second instance, the cash is higher than the bank. The next one is dishonored check. Check can actually bounce. Check can be dishonored. We have three reasons why check can be dishonored. Number one, if the signatures on the check does not correspond with the signature in the bank. You open the bank account and your signatures are not regular. What you have with you is different from what is in the bank, it will bounce. The second thing is that the amount on the check may be higher than your bank balance. If you have 10,000 naira in your account and you issue out check of 15,000, once it gets to the counter, the cashier will bounce it because the amount on the cash on the check is higher than the amount in your bank account. And the last one is at the expiration of a check. When the check expires, once you take it to the bank, it will not be honored again. Next one is bank charges and interest and errors. Bank can also charge you without your knowledge. Card maintenance and the likes. All these are charges that bank can take. Sometimes they can take this money from your bank account without your consent. What you just get at the end of the month is something that will be less than what you have deposited. So when this comes up, it will make the bank account to be less than the cash book. And then the next one is what we call standing order. I'm just rushing through because we really have where we are going. I want us to really have a background knowledge of these reasons so that by the time we look at the bank reconciliation statement, we appreciate the relevance. Now, standing order is just an order given to the bank to make payment on behalf of the customer. If I own a company, I may not need to bring all the cash to the company to pay my workers. I can just give the bank an order to make payment on my behalf at certain point or a certain date of the month, maybe second of a new month, first of a new month, or depending on the policy of the company. So if the policy of the company spell out that workers should be paid every first day of a new month, then I can pass that an order to the bank. So at every first day of a new month, the bank sends the alert, send the money to the workers. And then that, because sometimes you have recorded that the money has been sent, you have removed the money from your cash, but maybe the bank has not made the payment. So this standing order will make the cash book to be higher than the bank statement. And then the next one is dividend. Dividend is just the interest you receive in your investment in a company. When you invest in a company, the interest or the dividend you receive is called the interest, or the returns you receive is what we call dividend. This will be sent to your account straight. They may not bring it to the house. So sometimes they can send this money to your account without you knowing, because network will affect the alert the bank is expected to send you. So dividend is a money paid straight into your account. It will make the bank statement to be higher than the cash book. And then the second to the last is what we call credit transfer and debit and direct debit. Credit transfer is just you make transactions online and then you are credited. Money is paid straight into your account. It will also make your bank account to be higher than your cash book. While direct debit is when you make payment online. You buy items from Jumia, Konga. Once you populate or you input your necessary information, money will be deducted from your account. So this will also contribute to the discrepancies between the cash and the bank statement. Now, the very last one is what we call undercasting or overcasting of the cash balance brought down. You know, we are humans. Most of these things are carried out by human intelligence. So in the process, you can undercast or you can overcast. In accounting, counting is what we call casting. So when you say undercast, you are counting below the figure. And when we say overcast, you are counting above the figure. If the balance is supposed to be 10,000 and you mistakenly write 8,000, you have undercasted. If it's supposed to be 10,000 and you mistakenly count 15,000, you have overcasted. So all of these, put them together, will be responsible for the discrepancies between the cash book and the bank statement. Now, I want to just show us a chart that will present a summary of what I have said so far. If you look at this chart, you see causes of the differences, you see effect on the cash book, effect on bank statement, correction with the cash balance, correction starting with the bank statement. If you look at it very well, it is self-explanatory. Under the causes of the differences, you see all the reasons I have explained so far, the likes of uncredited check, unpresented check, bank charges, standing order, credit transfer, dividends, or dishonored checks, direct debit, undercasting of receipt side of the cash book, overcasting of the receipt side of the cash book. If you look at it, the effect is already showing there under the cash book, and then the effect is also shown on the bank statement. And then when you want to prepare the bank reconciliation statement, you can either start with the cash or you can start with the bank statement. So this chart will give you a guide on what to do if you are starting with the cash, and then if you are starting with the bank statement. So far, we have been able to give ourselves a rundown of what bank reconciliation statement is. Please, let's not forget. We said number one, bank reconciliation statement is a statement that is prepared to reconcile the difference between the cash and the bank statement. And then we have said that cash book takes out of cash receipt and payment or check receipt and payment, while bank statement is prepared by the bank to take care of the transaction between the bank and the customers. And then we said some reasons could cause the bank not to agree, the bank statement not to agree with the cash book. And we said they are unpresented check, uncredited check, bank charges, standing order, credit transfer, dividend, dishonored check, direct debit, undercasting of receipt side of the cash book, overcasting of the receipt side of the bank of the cash book. So far, can we now look at an example that will further explain what we have said so far? We are going to look at our exam guide. To look at our exam guide, so we'll be able to take an example that will further explain what we have said so far. Now, when you click on your exam guide, you are going to see options. Now, on the options, you see WAEC, objective, and then you see the theory. If you click on the objective, you will get to where we are now. Now, if you get to where we are now, you see different subjects. Our area of interest is account. That's why you see I have clicked on account. And then once you click on account, you see options there. You see the year. When you get to the year, you choose random, because at that point, you are going to, the question that relates to what we have said so far will pop up. And then once you have clicked on random, and then you can now get started. Now, the very first question here, it has bank statement. But for today's lesson, we are going to look at what will affect or what relate to what we have discussed so far. All right, let's look at this. A bank reconciliation statement is prepared to reconcile the differences between A, bank statement and credit transfer, cash book and bank transfer, bank statement and cash transfer, cash book and bank statement. We have said it reconciles differences between cash book and bank statement. So the answer is D. You click on D. Now let's move to the next one. It says a transaction that will cause the cash book balance to be less than the bank statement is very simple. The first one is direct debit. The second one is standing order. The third one is bank charges. The last one is unpresented check. Direct debit, I explained that when money is taken from your bank. Standing order, this is when money has gone out of the bank. And then bank charges, the same thing. So the only difference there, the only transaction that will make the cash balance to be less than the bank statement is what? Unpresented check. So unpresented check is the answer. Then let's go to the next one. Bank reconciliation statement reconciles, okay. Bank reconciliation statement reconciles what? Bank and cash balance in the cash book, bank balance in the cash book and bank statement balance, cash balance in the cash book and bank statement balance, bank balance brought down, and bank balance carried down in the cash book. I think we'll look at it again. If you look at B said bank balance in the cash book and bank statement balance. That's not correct. It's going to be bank and cash balance in the cash book, and then cash balance in the cash book and bank statement balance. So the C is the answer. The answer is cash balance in the cash book and bank statement balance. That is the answer. Let's take the fifth one. Okay, the fifth one, we are coming to this. A document sent by a bank to its current customer detailing their transaction over a given period of time is what? The A is bank reconciliation statement. That's not correct. Bank statement, credit transfer, banker's advice. It is bank statement. That's B. Let's look at question 7. Okay, which of the following does not appear in a bank statement? Which of the following does not appear in a bank statement? Very simple question. Now, we have said that there are some transactions that we enter the bank that will not reflect in the cash book. And there are transactions that will reflect in the cash book that may not reflect in the bank. They said, which of the following does not appear in a bank statement? We have said dividend received. This dividend goes straight into the bank account. Bank charges. These bank charges, they are money deducted from your account by the bank. And then uncredited check. I said this is check that has not been credited into the bank. Then dishonored check. Let me say something about dishonored check. You see, students usually make the mistake of categorizing dishonored check as a transaction that is not shown in the bank account. But that is not correct. Once you take the check to the bank and the cashier dishonor the check, it will be debited in the bank statement. So this bank, it cannot be dishonored check. The answer here is uncredited check, because this check has not been credited in the bank at all until the transactions on until the transactions on the cash on the check until that transaction reflects on the bank statement, it has not entered the bank statement. So the answer is C. And then let's take the very last one. We'll take the very last question, and then, okay, question 14. Let's look at question 15. I really want us all right, to look at what relate to what we've done so far. Uncredited checks refers to check not yet credited. Credited in where? In the cash book, by the bank, by the drawer, in the ledger, is by the bank. All right, so far we have come to the end of the lesson. But before we finally conclude, I have said from the beginning that today's lesson, we are going to be looking at our objective. Let's look at our objective so far, so we'll know if we've been able to achieve our objective today. Now, what is the objective of our lesson? The objective of our lesson, we have said that we will define bank reconciliation statement, and then we will, okay, let's look at the objective. Say define bank reconciliation statement, explain reasons for the differences between the cash book and the bank statement, and then solve related problems. So far, I am very sure that at this point, you'll be able to define bank reconciliation statement, and you'll be able to explain the reasons for the difference between the cash book and the bank statement. And then we've been able to look at some related questions.